What's up, guys? Welcome back to DCA. Tonight, what we're going to do is talk about the DCA Index risk model. So, a lot of new people have joined the channel in the last few weeks, and I haven't really done a proper update on what the DCA Index risk model is. So, I just wanted to elaborate on that a bit tonight. And what the model is a machine learning algorithm model which has been optimized in attempt to identify where market cycle peaks and bottoms will occur. Okay, so you can see that the model basically spans back through the 2011 through 2014 market cycle and has done a fairly good job at identifying where the market cycle top will occur during each individual market cycle. So you can see back in our double peak cycle that we had in mid and late 2013, the DCA index risk model was near topping out at that point. It topped out at this point here in the late 2017 market cycle. And then now we saw our peak occur in February of 2021 when Bitcoin was near approaching $60,000. All right. So, on the flip side of that, you can see where the model has nearly reached a bottom, and that has been at the COVID capitulation event in March of 2020. Back in 2018, when Bitcoin went down to low $3,000 levels, and you can see it got down near to the bottom of the risk band here. And the model goes from 0 up to 100. All right, so it reached almost down to 0 in late 2018. All right, and the other time where we've seen the model head down to these lowest levels was here in January of 2015, right at our market cycle bottom. All right, so this is what the model does. And, I have several videos discussing the model out there, and I go into detail as to what goes into the model. We talk a lot about how to use the model, what the best strategies are. So tonight I wanted to talk about something a little bit different. I want to go over the historical data for this model and show you just sort of how the model has been holding up from market cycle to market cycle to market cycle, right? And show you the characteristics of the model, sort of where the most common levels that the model sits at, and what considerations we can think about when we look at this histogram data that I'm about to show you. Okay, so basically what we have here is a graphical representation of each individual market cycle. All right, so this is the 2011 to 2014 cycle. And you can see that in this cycle, and we could just go back here. And so, we're looking at this in a different way. We're looking at this information color coded by individual market cycles. And just to clarify, we are counting a market cycle as being a bottom point of the market to the next top down to the next bottom. All right. So it goes bottom to top to bottom. All right. Rather than looking at just, sort of cherry picking data and going from bottom to top. So we're going to go from a market cycle bottom all the way to the top and then down to the bottom. That will count as one market cycle. All right. And, what you see here is just this color coded data for each individual cycle. So this is 2011 to 2014, and then into basically all the way to the beginning of 2015, and then 2015 all the way to late 2018, and then this current market cycle, late 2018 into current day. All right. So the first thing we note, back in 2018, like we said, we had our double peak cycle. And that sort of speaks to the fact that every market cycle is going to be a little bit different than any other market cycle. So in 2018, during the first peak, we didn't quite get into this highest risk band. In fact, we were only able to get up to about 87 or so. And then right at the end of the sort of the peak in late 2013, in November of 2013, we were able to get into this highest risk band, right? Then we just plummeted, and that's represented if we just go back to the price. You can see that the price actually, went down just dramatically over time, and we went basically from, if we use this tool here. We were down approximately 85% or so. Okay. So, there was just a dramatic drop in price, and that's represented on the DCA index risk model. You can see that we got down basically down to about a 4 on the model, and that's nearly as low as you can go. All right. So then moving on, the market recovered, started to recover in 2015, and then we reached a single peak in late 2017. All right. Other than that, it was just sort of hanging out in the 40 to 50 and the 50 to 60, and then for a bit in the 60 to 70 levels. Right. Then again, we had this long, protracted, severe drop in price going from 20,000 all the way down to what we showed before, down to about $3,200, all right, in late 2018. And now the current market cycle. So this first peak that we had was in 2019, and we can just look at that quickly here. This is that first peak in 2019 occurred right here. Now, remember that we were able to get into 60 in the 60 to 70 level at that time. So, if you were acquiring all through this period, you could have taken some profits here, all right? And in fact, made some decent gains because you would have been purchasing Bitcoin all the way from around $10,000 or so, all the way down to $3,000. And then you had an opportunity to sell at, not all of your Bitcoin. And again, if you're interested in the strategies that I use for the model, I've done plenty of videos on that, and I'll leave a link to those in the description below. But you had the opportunity to sell at around $13,000, right? And in fact, you can see that when we got into the 70 level, just a few days, maybe 3 or 4 days, Bitcoin was trading up here at around 12,000 up to, $13,000, right? Then we went back down. We needed some more time before the market could really get kicked off, and we trended back down. And then after the COVID capitulation event, you had another great opportunity where we, for a very short amount of time, got as low as 10 on the DCA risk index. All right. And that occurred right at around $4,800. Right. Now, since then, the market has gone back up, and we did in fact reach into this highest risk tier yet again, right at around nearing $60,000. Okay. So that's kind of, a breakdown of each individual market cycle. Now, this is what I wanted to show you in particular. This is a histogram demonstrating where the, what risk levels the DCA index risk model has been at over the course of the market cycle. All right, so this is back to our 2011 to 2015 market cycle. And you can see that essentially the majority of our time has been spent in this 30 to 40 risk band, with another large percentage being in the 20 to 30 zone, and then slightly smaller than that in the 40 to 50 zone. Okay, so the vast majority is spent below 50, and that's the time where we're acquiring Bitcoin. When you're below 50, you should be, or you can do whatever you'd like. This, as per usual, this is not financial advice. This is how I approach the DCA index risk model. I acquire when it's below 50. Okay. So when it's below 50, I'm acquiring, and you'll see the majority of the time is spent actually below 50. And in reality, you get very scarce opportunity to acquire at these very lowest risk bands, this 10 to 20 and this 0 to 10 level. So of all of these days, approximately 1,200 days, you only got about 90 days to acquire at these very premium acquisition levels. So, what this translates to is, if we just go back to this cycle, you have to remember that during these times when you're down here, these are the times when, every single person on planet Earth is telling you Bitcoin is a scam, it's going to zero. So, quite frankly, it takes a lot of balls to be buying Bitcoin down at these levels. However, at the end of the day, this is where you can make truly life-changing profits. If you stick to your guns, if you have conviction in Bitcoin, if you have conviction in cryptocurrency, when you get down to these levels, people are sitting on 90% losses, at this point, like we just showed. Like if you're starting up there and you come all the way down the bottom, people are sitting on near 90% losses. Okay. So, like I said, there's going to be everyone and their mom telling you Bitcoin is dead. But, if you have conviction, these are the best times to be buying. So if we just keep going, and conversely, the opposite is true. You get a very essentially small window in this 70 to 80, 80 to 90, and 90 to 100 level relative to the total number of days in any given market cycle. So we see a similar type thing back in 2015 through 2018. We're seeing, if you look at the 30 to 40 and the 20 to 30 and the 40 to 50 zones, just like in the 2011 to 2015 market cycles, those are the majority on the risk level. You're going to be in this 20 up to 50 level, primarily in the 30 to 50 zone. Okay. And this cycle was nearly identical as far as that goes. And yet again, we have another approximately 1,300 day market cycle based on the way that we are measuring the market cycle from bottom to top to bottom. And yet again, you get a relatively small quantity of time relative to the total amount of time where you can be acquiring at these premium levels. And that was reflected sort of basically right at the start of the market cycle and down here, right in this zone. These are the levels where you can be buying Bitcoin. In this market cycle, for instance, you could have been buying from $6,000 all the way down to $3,000. And yet again, these are the times when everyone is telling you Bitcoin is a scam, it's a Ponzi scheme, it has no value, it's not backed by anything, Peter Schiff seems like a genius, etc. Okay? First market cycle, second market cycle, we're seeing a very similar picture. Just quantitatively, if you look at the shape of the histogram, they look very similar. And, yet again, you're getting a relatively very short amount of time to be selling at these best risk levels. All right. So 70 to 80, 80 to 90, and 90 to 100. So that brings us to our current cycle. And this one has been very similar in the grand scheme of things, although with several slight differences. So you're seeing we haven't spent as much time within the 20 to 30 level as we have in prior cycles. Although, if we look at where we're at right now, you can see that as long as Bitcoin doesn't make a big recovery, and in fact, if we keep heading down, we're sitting in this 20 to 30 zone right now. All right. So we're in the 20 to 30 zone right now. And overall, typically what we've seen is the 20 to 30 zone is actually higher than the 40 to 50 zone. But so far in this market cycle, that has not been true. Other than that, the graphs look pretty similar. I think we've had more time in the 70 to 80 zone. And that's likely as a result of the fact that we haven't really had we haven't had a true blow off top type event this market cycle. And I suspect those are going to become less, overall, they're going to become less prevalent as time goes on. We're not going to see these absolute blow off tops simply because of the market cap. It's very, very tough to get a blow off top on a $1 trillion market cap asset because the quantity of capital that has to pour in to the market is just immense. I mean, it takes, if you're at $1 trillion, it's going to take $100 billion just to get, even a relatively small rise. You're only going to be getting a 10% rise or so on the market cap with $100 billion on a $1 trillion asset. So, put that in perspective. Sure, it's not so difficult. And if we just actually come over here to the Bitcoin market cap, and if we look at the Bitcoin market cap, it's quite a bit easier to get a blow off top on an asset that just prior to the blow off top is sitting at a total of $127 billion. So sure, you have $200 billion come into the market, you're going to get a blow off top. But, it's a whole new ball game when you're sitting at $1 trillion, $1.3 trillion to get a blow off top type event. You're going, you got this blow off top because you went from, 150 billion up to 300 billion. And that's a blow off top. When you're sitting at 1.3 trillion, $150 billion into the, added into the market is simply only going to give you a relatively small change, whereas that same amount of capital added into the asset back in 2017 is giving you basically an instantaneous 2x. And you're just not going to see that anymore. And you're not going to see, these type events where in a day's period you have $1 trillion come into the asset, which is essentially what it would take right now in order to get a day-to-day 2x. Okay, so that's kind of where we're at right now. Relatively over time, these histograms look very similar with slight changes where we've sort of added, a bit more time spent here in the 70 to 80 zone and, a bit less time spent in the 20 to 30 zone. But remember, the market cycle is not over yet. So the whole dynamic could continue to shift, and at the end of the day may end up looking very similar to what you're seeing with our prior market cycles. In fact, it already does look very similar with just slight differences. Now, if we suspect the market cycle is to continue and lengthen, which I do, then we may sit around in this 20 to 30 zone for a significant amount of time, in which this would rise. This may stay stable. We may just blow through this 40 to 50 on the way back up, and then sort of, head into these higher zones before we come down. So that's going to be it for this one, guys. The DCA Index risk model is available for free. You can sign up for it on the Discord or Telegram channel, and I'll get it sent out to you. There's a link on both Discord and Telegram. We do most of our, we spend most of our time on the Discord channel. So I would recommend heading over there, signing up for the DCA Index risk model. It's a TradingView indicator. We have it for Ethereum and all of the top altcoins. Like I said, that's it for this one, guys. And until next time, as usual, see you.